Welcome to the Dental Brief, the world's direct, right-to-the-point podcast produced to get you the information you need to learn and grow your practice. To learn more about our guests and find links to information discussed on our show, visit our website, dentalbrief.com. On to today's episode.
Hello, everyone. Welcome to another episode of the Dental Brief. Today, I'm excited to have with me Randon Jensen from CTC and Associates. Randon, go ahead and say hello.
Hi, Patrick. Great to be on.
Yeah, it's great to have you here. Randon, I understand that you're an expert in dental transitions, acquisition, helping dentists find practices, helping practice owners who are ready to transition out or into a retirement, find dentists to work with. So tell us a little bit more about your background. Where do you office out of? What areas do you serve?
Yeah, of course. Yeah, we're fortunate to work with a lot of great dentists, dental specialists. We work exclusively with dentists, and all we do are practice transitions. So appraisals, associateships, mergers, partnerships, and then, of course, outright sales. We've got a business partner, Marie Chatterley, is in Denver. Another business partner, Crystal Smith, down in Phoenix, and then some administrative staff as well. I'm in Salt Lake City, and so we cover Utah, Colorado, Wyoming, Idaho, Nevada, New Mexico, Arizona, kind of these surrounding states. Been at this 21 years now. Larry started originally back in 88. I think at last count, we've facilitated just over 1,800 practice transitions. So worked with a lot of great dentists over the years.
Wow, that's terrific. So one of the things that I know we want to have you talk about today, I'm going to ask you to talk about, is financing. So financing a practice, whether it's a startup or whether it's a transition you're buying into a practice. I know that there's some new challenges today based on COVID. What challenges are you seeing dentists have out there today?
Well, yeah, right now it's kind of unique because of COVID, there were some big players. So first of all, I should point out there are lenders that specialize in practice acquisition financing. That's a question I get a lot of time: is where do I go to get the money? And what we found historically is local banks and credit unions, as a general rule, have not been a good resource. Usually, a dentist will come in pitching or making an application for financing to acquire a practice, and the bank will take a look, or the credit union will take a look and say, hey, this on the surface looks great because of the numbers. They start looking at collateral and determining, well, man, the practice, only the equipment represents maybe only 20-30% of the overall value of the practice, and that's our collateral. So we're really not comfortable doing this unless we go through a small business administration loan, an SBA loan. There's a place for SBA lending, but as a general rule, there's so many other better conventional financing options available that I tell dentists, there's no reason you need to go SBA. So there was lenders, and that hasn't always been that way. It was probably the late 90s that some of these lenders came onto the scene and discovered that dentists were really pretty good risks. In fact, historically, I haven't looked at numbers recently. I don't know how COVID has affected this, but for years and years and years, the default rate on practice acquisition loans has been less than 0.5%. So even though very little collateral in these loans, they're essentially unsecured loans, these lenders have determined that it's a pretty good risk to make these loans to dentists. So we've been fortunate to have those dentists in this marketplace. Now, recently, some of the big players, the big dental finance, practice acquisition, and startup finance lenders have stepped back because of COVID. With the closure, they just weren't sure how that was going to affect dentistry, both short-term and long-term.
Sure.
So, yeah.
Just real quickly. Sure, that makes a lot of sense. So, since backing out or slowing down, right? And I know that was the case. I heard it and saw it firsthand. Have you seen them start and ramp back up?
Yeah. So it's interesting that a lot of them took a step back. And even during that period of time, with them taking a step back and maybe not processing new applications or being very selective about the applicants that they would bring on during that period of time, we found that there were other lenders who've been waiting in the wings, really wanting to enter this space and gain market share, that used this as an opportunity to step up and step in and step up. And so even during the period of time of closure and whatnot, we were still able to get loans approved through lenders, and financing was taking place. So I'm telling doctors now, don't worry about a lot of, I think the prevailing rumor is that financing is not available right now, and that's just not the case. And these lenders that took a step back are now stepping back in, and in a strong way. Some are offering some pretty strong incentives, some fantastic rates that we've never seen before. Really to say, hey, we're back, and we have faith in dentistry and where it's heading, and we're ready to start lending again.
Yeah. So with rates being much lower right now in practice financing than they were some time ago, I have to think that it probably is a really good time for young dentists to look into buying a practice if they haven't before. Would you agree with that?
Oh yeah, absolutely. Yeah. So there's a handful of things, but yes, definitely right now, buying a practice, you have a lot greater buying power, if you will, when your interest rate's low, or you can buy more, you get more for your money, essentially.
Sure.
Yeah, which stands to reason. A few things that and I'm probably anticipating a question before you ask it, Patrick. Sorry, but some of the things that lenders are looking for, that these new dentists are looking to get into career, into practice ownership. Some of the things that the lenders are looking for that may be helpful for them to know. And every lender is a little bit different, so this is just generalized across the board. But 4 or 5 things that they're looking for. One, they're looking for a credit rating, right? They want to see that the prospective practice owner, that the dentist pays their bills. So FICO score is 700 or above. Generally, we're fine. Anything lower than that, that's a little bit more challenging. Second, they want to see some experience. Used to be we could lend to new graduates right out of the chute, but those days are gone. There are a couple lenders that will lend, but they limit the amount they'll lend to new graduates. So usually they want to see, the magic number is about 2 years, but really what they're looking for is the doctor's ability to produce at a level commensurate with the size of the practice they're looking to buy. So I may have a dentist who's been out 15 years, but if he's never produced more than X dollars and he's looking to buy a practice that's 3 times that size, may still have a trouble getting financing. Lender may question the doctor's ability to handle the practice they're looking to buy. Third thing they're looking for is a little bit of liquidity. I get the question, does that mean I need to bring cash to the table, or that I need to have a down payment? No, they just want to see that you have a little bit of money, a rainy day fund, for lack of a better term, in case things get a little tight, that you can pull on. Every lender is a little bit different, but as a general rule, about 10% of the loan amount they want to see in some type of cash reserve or liquidity of some type. And that has, ironically, there have been some dentists that have qualified in every other way and been very strong on paper. But for whatever reason, they've started paying down student loans. They started making money in an associate position, and used that excess money to start paying down student loans rather than setting a little aside for a rainy day fund or for savings. And that actually hurt them, because the lenders are expecting them to have student loans, and the size of the student loan isn't as much of an issue for the lender as it is the monthly payment on it. So that's usually a tidbit I like to tell docs. Hey, if you're getting a little extra cash that you're making, don't necessarily start paying down your student loans. Not that that's a bad thing, but if you're hoping to buy a practice, set it aside so you have a little cash reserve. Sure. And then the last thing they're looking at is the practice itself. They're looking at the cash flow of the practice. So that's where, some lenders say, well, we can pre-qualify you, but even then they will admit the pre-qualification doesn't really mean a lot of things. It just means we've run your credit and we know that you're creditworthy, but any approval will have to be contingent on the actual practice being purchased. And in that sense, what they're looking for is this kind of an oversimplification of the process they use, but they'll take the practice, they'll factor in true operating overhead, adjust for any discretionary or investment related expenses, and then they'll take that, and from that they'll subtract the borrower's personal financial needs. So the borrower will fill out a personal financial need assessment to determine how much they need to live off of each month, including their car loan, their home mortgage, their student loans, etc. If the practice nets enough to cover that plus what they call a liquidity ratio, then whatever's left over, they do a kind of a reverse amortization. And if that'll cover the debt service for the practice acquisition, then we've got an approval.
Got it. Yeah, that makes sense. So let me ask you, Randon, what are some steps, or what should a If you're looking to work with a bank, if you're looking to buy a practice or do a startup, how do you go about vetting a bank? What's the best thing to look for? What questions do you need to ask? I think everyone asks about interest rate, but there's a lot more to the cost of money than the actual interest rate. Right? There's a lot of other things that are important. So kind of what's the checklist that you think people should have before they start talking to bankers or when they talk to bankers?
Wow, excellent question. Yeah, because so many times they just get caught up on the interest rate, not realizing that there's so many other factors that can influence it. Some lenders will have brick and mortar in the area, and some will require some type of a banking relationship after the fact. Buyer has to decide whether or not they want to have that requirement, or some may want that. They may want to have a bank that's close by that they can walk into a branch if they have questions about servicing their loan or whatnot. Some are, that's not as important, and having technology and other things. I think as a general rule, having somebody who's responsive is important. But as far as the loan terms, looking just beyond the interest rate, some of the areas that I see overlooked, origination fees. Most lenders have very, very little by way of origination fees. They're very minimal, but that can make a huge difference in the effective rate, right? If there's a big fee up front. And that's one of the downsides with SBA lending, for example. It's very, very costly in terms of fees and upfront costs. Variable rates versus fixed rates. Most specialty lenders are fixed, but that's another thing to look at. Prepayment penalties. That's a question that will come up periodically. Some doctors want the ability to to pay down the loan sooner. So most lenders will allow principal reduction payments up to a certain percentage of the loan. So they're allowed to do that, but they may have penalties for an outright payoff within the first, 2, 3, 5 years of the loan. So those are all things to consider. Now, here's another area that I've seen borrowers get in trouble with. A lot of times lenders will come and say, well, we'll give you this 6 months no payments, or 12 months no payments, or 3 months, whatever it may be. And what they don't realize is that they're really not deferring those payments. Those payments are still accruing, or the loan's still accruing interest during that period of time. Sure. And then the interest gets added to the principal. So it's negatively amortized. And they don't realize that. They don't understand that. And so I usually tell the borrowers, well, if you want a graduated payment, see if you can at least do an interest-only payment so that you're not paying interest on interest. And so I have seen some that have, well, that looks really great. I get 12 months, no payments, but ends up costing a lot more in the long run. Same's true with like 15-year amortizations versus 10-year. The practice should be able to cash flow the debt on a 10-year am. If it's not, then there may be something else amiss there. But a lot of times they'll go, well, I want to go with the 15-year am because I get a lower monthly payment, but not realizing they will pay a lot more in interest. So there may be benefits to doing the numbers, or if they feel like they want to go on a 15-year am, but they're going to be disciplined enough to make additional principal reduction payments to pay it off in 10, then they can save themselves that interest.
So I want you to reiterate one thing that you said at the beginning of this. I just think beginning to the end, kind of sandwich it in there. You said rates are at all-time lows, correct? Right now for dental financing?
Yeah, they are. Yeah, when I started the very first loan, I got approved for a borrower. I remember sitting in the car talking with the lender outside of the office, and this was in 1999, and the rate was 14%.
Wow.
And I remember saying to the lender, wow, that's crazy. And he's like, hey, that's the going rate. That's what it is. So right now, most rates, and of course, at the time of this recording, most rates that I'm seeing, fixed interest rates for practice acquisition lending, are in the mid fours. Wow. But there are some promotional rates that are even lower than that, in the upper twos and low threes. So
wow, that's fantastic. I mean, that's a significant discount on the cost of a practice. I mean, yeah. I don't want to step on your toes at all, but the cost of the practice is one thing, right? The cost of the startup is one thing, but then the cost of the money is something else. And if the cost of the money is lower, I mean, it's just, you don't have to be a rocket scientist. You just have to think about it for a second to realize, wow, the overall cost is lower than it has been in years past. I mean, that's fantastic.
Yes. Yeah. So we're really fortunate because these lenders haven't always been around, but we're very grateful that they are. I think it's a great service for the dental community. And of course, it's great for the work that I do to have these lenders available and to make these transactions possible.
Yeah, well, let me tell you, Randon, we're grateful to have you here. For our listeners, you can reach Randon Jensen at CTC and Associates at their website, which is ctc-associates.com. Reach out to him. He's a great resource in the industry. We're very thankful to have you here, Randon.
Thank you, Patrick. Such a pleasure to be on.
Great. Let's have you back sometime soon.
Sounds great.
Take care.
Bye.
Thank you for joining us on today's episode. Did you know you can weigh in on today's topic on Facebook? Search The Dental Brief on Facebook or visit our website, dentalbrief.com, and just follow the link. We look forward to having you join us again on another episode of The Dental Brief.